What if you quit 1 year too early? Not 1 decade, not 5 years, 1 year. What if the account you closed, the automatic transfer you canceled, the app you deleted in frustration? What if that was 12 months away from the point where everything changes? Because for most people who quit investing, that is exactly what happened. They stopped right before the curve bent, and they never knew it. Let me tell you about Marcus. Marcus is 34. He started investing 3 years ago. He was proud of himself, genuinely. He set up an account, figured out what an index fund was, automated $250 a month, and told himself this was the year he finally got serious about money. Year one, he checked his account every week, sometimes twice a week. He was excited. He watched the number go up a little, sometimes down a little. Mostly it just sat there looking almost exactly the same as the month before. He had put in $3,000 and his account showed $3,180. $180 in a whole year. He kept going. Year two. The market had a rough few months. His $6,000 in contributions showed a balance of $5,400. He was down. He had done everything right, and he was actually losing money. His brother-in-law was talking about a property he flipped. His coworker kept mentioning some stock that tripled. Marcus started to feel something. Not panic exactly. More like, what is the point? He did not sell everything, but he stopped the automatic transfer. Just for a month, he told himself, just to reassess. That month became 3 months. 3 months became 8, and then a full year passed where nothing went in. By year three, he checked the account one more time, saw a balance of $6,100, barely more than what he put in over 2 years, decided this clearly was not working, and moved the money into his savings account where at least it felt safe. Marcus quit. And here is what kills me about Marcus's story. He quit in year three, the year the curve was about to bend, the year the compounding was about to stop feeling invisible and start feeling real. He was 3 years into a 30-year journey, and he judged the entire destination by the first 10% of the road. To understand why Marcus quit and why most people quit, you need to understand one thing about how compounding actually works. Because the way most people imagine it is completely wrong. Most people hear, your money grows over time, and they picture a straight line. Steady. Predictable. Put in $250 a month, watch it climb steadily upward, feel good every single month. That is not what compounding looks like. Compounding looks like a hockey stick. For years, sometimes many years, it looks almost flat. Almost nothing. You are contributing. The growth is happening, but it does not feel like it. The numbers barely move, the progress feels invisible, and then, somewhere past the middle of the journey, the line starts to curve, and then it curves harder, and then it does something that looks almost impossible compared to those flat early years. It goes nearly vertical. This is called the compounding curve. And the cruel trick it plays is this: the most dramatic, life-changing growth happens at the end, which means the people who quit in the early flat years never reach it. Let me give you an analogy that makes this visceral. Imagine you are pushing a boulder up a hill. For the first few years, you push. The boulder moves, but slowly, painfully slowly. You are sweating. You are working. And the boulder is barely moving. Someone watching from a distance would barely notice you were making progress. Most people stop here. They decide the boulder is too heavy, the hill is too steep, it is not worth it. But here is what they did not see. They were almost at the top, and on the other side of that hill, the boulder rolls on its own, faster than you could ever push it, faster than feels possible from where you were standing at the bottom. The pushing was the flat part of the compounding curve. The boulder rolling downhill, that is the curve bending. Every person who quit investing early stopped pushing. Most of them stopped when they were closer to the top than they ever knew. There is a second reason people quit, And this one is even more dangerous because it feels rational. They react to the market. When markets drop, which they always do, always have, and always will, the account goes red. The number goes down. Something that took months to build disappears in weeks. It feels personal. It feels wrong. It feels like the market is doing something to you specifically. So people sell, or they stop contributing. They want to wait for things to calm down before they get back in. And in doing so, they make the single most expensive mistake in investing. They sell low, and by the time they feel calm enough to get back in, prices have already recovered. They buy back in high, they locked in a loss and missed the recovery. They did not protect themselves. They guaranteed the bad outcome they were trying to avoid. Let me show you exactly what quitting costs, because the number is genuinely shocking. Back to Marcus. Age 34. He invested $250 a month for 2 years, then stopped. Total invested, around $6,000. He walked away with roughly $6,100 in his savings account. Now let me show you two futures. Future 1, Marcus quit, which is what actually happened. He moves the money to savings, puts it in a high-interest savings account at around 4%, feels responsible. By the time he is 64, 30 years later, that $6,100 has grown to roughly $19,800 in savings. Not nothing, but not life-changing. And the $250 a month he was investing, it went back into his spending. Over 30 years, that is $90,000 that just lived in his lifestyle. At 64, Marcus has $19,800 saved. Future 2, Marcus had stayed. He keeps the $250 a month going from age 34. Never stops. Index fund averaging 8% annual return. He does not touch it. He does not watch it weekly. He just lets it run. By age 44, 10 years in, his account shows approximately $46,000, starting to look real. By age 54, 20 years in, approximately $148,000. Now it is undeniable. By age 64, 30 years in, approximately $375,000. $375,000 from $250 a month. The difference between Marcus's two futures is $355,000. He did not lose that money in a bad investment. He did not lose it in a scam. He lost it by quitting. He lost it by making a decision in year 2 that he would not have made in year 20 if he had just stayed long enough to understand what he was looking at. And now here is the one that hurts even more. Remember, Marcus quit during a market dip. His account showed $5,400 when he stopped contributing. Within 14 months of him quitting, the market had recovered. His account, had he stayed, would have been back above his contributions and growing. He felt the pain of the dip. He did not feel the recovery because he left before it came. So what does Marcus do differently? What do you do differently? Here are 5 things that keep people invested when everything in their brain is telling them to quit. Step 1. Never look at your balance in dollars. Look at it in shares. This is a mindset shift that changes everything. When markets drop, your account value in dollars goes down. That looks scary. That triggers emotion. But when markets drop, the price of each share also drops, which means every $250 you contribute that month buys more shares than it did last month. You are not losing. You are shopping at a discount. Your share count keeps going up even when your dollar balance temporarily goes down. Focus on the shares. The dollars follow later. Step 2. Set a checking schedule and stick to it. Once a quarter. That is it. Not once a week. Not every time the market makes the news. Once every 3 months, you open the account, note the balance, close it, and move on. Frequent checking does not make you more informed. It makes you more emotional. And emotional investors consistently underperform boring ones. Step 3. Automate everything and make it hard to stop. Set up the automatic transfer and then add friction to canceling it. Move your investing account to a separate institution from your everyday banking. Out of sight genuinely does help here. The harder it is to access the money, the less likely you are to react in a bad moment. Step 4. Write down why you started. This sounds almost too simple. Do it anyway. Take 5 minutes. Write down what you are investing for: retirement, freedom, not working forever, a different life than the one you grew up watching. Whatever it is, tape it somewhere near where you do your banking. Because when the market drops and your account goes red and every instinct says, get out, you need to remember that you are not investing for this month. You are investing for a version of your life that is 20 years from now. Your future self does not care about this quarter. Step 5. Use a market drop as a trigger to invest more, not less. This is the advanced version, but it is how wealth is actually built. Every time there is a significant market drop, 10%, 20%, that is a sale. Every share you own is cheaper. Every share you buy is cheaper. The people who built serious wealth from investing did not survive the crashes. They took advantage of them. Reframe the dip from a threat into an opportunity, and you have crossed a line that most investors never cross. Here is the thing nobody tells you about investing: the strategy is not the hard part. Index funds are simple. Automation is simple. Time in the market? Simple. The hard part is the psychological war you fight with yourself every time the account dips, every time someone else seems to be winning faster, every time you wonder if this is even working, every time 3 years in you look at your balance and think, seriously, this is it? That feeling, that specific feeling of doubt in the early flat years, is the price of admission. Every single person who reached the steep part of the compounding curve paid it. Every person who has a portfolio that works for them, that generates income, that eventually replaced their salary, they all sat in that flat section wondering if it was worth it. The only difference between them and Marcus is that they stayed. Not because they had more money, not because they had a better strategy, not because the market was kinder to them. They stayed because they understood something Marcus did not yet know. The flat part is not a sign that it is not working. The flat part is the work. And the people who do the flat work, who push the boulder up the hill when it feels pointless, when it feels invisible, when literally everyone around them seems to be winning faster. Those are the people who get to feel the boulder roll. You are going to have a moment. Maybe you have already had it. A month where the market drops and your account goes red and you think, why am I doing this? A year where you put in $3,000 and the account barely moved and you think, this is not working. A conversation with someone who made money faster, doing something completely different, and you think, maybe I am doing this wrong. That moment is not a sign to quit. That moment is the test. Because on the other side of that test, for the people who pass it, who stay, who keep the $250 going when nothing seems to be happening, is the curve, the bend in the hockey stick, the boulder cresting the hill, the point where your money stops needing your permission to grow. Marcus quit in year 3. Don't be Marcus. The only investors who never reached financial freedom are the ones who stopped. You are still here. That already puts you ahead. Drop a comment below and tell me, where are you in the journey right now? Year 1? Year 5? Have you quit before and started again? Tell me. Every person reading these comments started exactly where you are. Let's keep each other in the game. Subscribe to Noella Invests. Every week we have the conversation that keeps you from making the mistake that costs you everything. See you in the next one.